Hello everybody and welcome back to the channel where we talk about stocks, commodities and cryptos daily. We've got a special video today because we're taking a look at an indicator that has predicted 5 US recessions already occurring before the official numbers come out. Now, many of you will already be saying, yes, we are in a US recession. We already know that. Yes, that's probably true. However, it's important to note what happens after that point in markets. And we'll be taking a deep dive at the S&P 500 today, both from a longer term perspective and also the shorter term perspective signals. At this stage, we know we just broke out of a coiling market. In our previous videos, we've done a good job of managing this expectation and area. With the breach out that we saw in the past session, does that mean that we start the July trend? The first 2 weeks of July, I've got some big stats talking about that and what generally tends to happen. But any bull rally that occurs right now is going to come into important zones such as this trend line. The other problem is it looks like there's still a lot of selling going on from the street. So is this all part of a recovery triangle or some kind of bigger sell-off squeeze? Let's talk about it right now. See you soon. Well, welcome back everybody to the channel where we talk about stocks, commodities and cryptos. We thought we'd begin today by discussing ISM manufacturing new orders versus existing inventories. And you can see here that when we take a look at it, when it falls under negative 6.8, the last 5 times this has happened, we've already been in, or we were in, a US recession. Sometimes it can predict it before it just quite happens. And that's something that's very important. Sometimes you want these predictions. Obviously, right now, what we're seeing is people are fearful. The demand destruction that's been caused by the Federal Reserve raising rates at such a fast rate, and you'll find out they're going to raise them even faster than you expect in just a few moments, is causing this huge decline in sentiment within the general population. As we know, 1/3 of the US economy is consumer spending. So if we have a huge drop off in that, what happens? It affects everything. And of course, it causes usually a recessionary period. And that's what the market's moved on from. It's not actually about inflation anymore. It's now the discussion is how much damage is the Fed doing trying to smash this inflation out. And of course, they've got to keep raising rates at a very fast rate to really hammer in that fear and to drop the demand, which they can control the best. And if you're new here, definitely subscribe because we've talked about this a lot over the last couple of months. And of course, we will go into some serious in-depth analysis over the next few weeks to try to figure out whether we're actually basing here or we've got a new drop coming through. January, February, change in monthly visits to malls. Look at this. Very, very, very good. Everyone's feeling great. And then all of a sudden, we're not feeling so great. It's funny how when the markets go down, we feel poor. It all starts to reverse. We're into a point now where basically you can see here mall visits are turning negative year on year. And this is going to have profound impacts across realistically the entire economy. The stock market is smart, so it already thought about this and it's already put a lot of that kind of stuff packed into price, but there still could be more to come, and we'll talk about that a little bit later. Let's see what the longest trades are at the moment though. The most crowded trades in June of 2022 have been, of course, the one such as oil, commodities. That didn't work out so well. When everyone thinks something, often it doesn't happen. What have we seen happen to oil since June? It's fallen off a cliff. Why? Demand destruction. But of course, when you look at the numbers, everybody was in it. At the moment, the most popular trades, of course, have been long dollar. What's happening at the moment? Long dollar is doing pretty well. This is big traders here, of course. And then we have also short treasuries. But notice what they did. They were very short treasuries, and then all of a sudden they reduced it heavily. So it'll be interesting to see the next month's numbers because I have a feeling the big players are starting to reduce partially their commodities trades, and a few people went short. And the other thing is as well, we have a lot of people that were short treasuries reducing their positions because they're starting to see exactly what we're seeing here on the channel, which is we call that top of the US 10 rate, US 10-year rate, US 2-year rate, all of those types of things. They're starting to drop because the yield curve in bonds is basically looking like this. For anyone that doesn't know, basically the Fed's going to have to raise rates really, really fast and then cut them in 2023 to try to support the economy. Knock the inflation out, come back in with the support. That's what they're going to have to do. And this is the most likely scenario at this stage in the economy. A very important point. Hopefully you understand what we're talking about. In terms of actual target rates at the moment for the Fed, notice here, 1 day ago, only a few days ago here, the 5th of July, 83% likelihood that we would raise rates a significant portion in the US. Guess what? That's now sitting even higher. So if you're not surprised by a 75 basis point hike, well, that's good because, of course, you already can see most of the big players out there expect this to happen. A 75 basis point hike seems to be the current consensus from the street. And this is a very big thing. 75 basis points, that's huge. I mean, whether it's 50 or 75, the street's already aware of this, even though the mass media probably isn't. And I'm sure when they do something like that, it'll be like, whoa, another massive increase. Yeah, well, you need to be aware of this way faster. The stock market doesn't work on the news media time. It works on what it's actually showing you in the real time. And that's, of course, why many of you follow many YouTubers and, of course, really great Twitter and everything else out there in terms of being able to follow these charts. The key is to be able to see it yourself, though. Understand how to find it. S&P 500 seasonals for June into July. Now you'll notice here there tends to be a fairly strong correlation with the first 2 weeks of July in terms of strength in the markets. Now that's the important part. The first 2 weeks of July tend to be good. Let's have a look at the numbers here. In fact, the first 2 weeks of July are the strongest numbers over 70 years of history. Now, of course, this year is not always like that. We haven't seen seasonals play out as much as they used to. And seasonals are still a very great concept, but you need the technical analysis. You need the actual price action, the flow, all of these things coming with you. First half of the month of July, though, tends to be quite strong. Second half of July is still okay. It's still positive, but nowhere near as much. So you can see that this is a very important point. Second half of June, second half of September, they tend to be quite poor by statistical averages, but notice that July pick up. So will we get it? Hopefully we do. It's the time that it's going to happen if it is going to happen. Notice here as well the stats that we've put together. I'll just quickly, you should pause it if you haven't seen this before. Basically at the moment we have a couple of greenish kind of days here statistically by, all of the stats that are taken out over history. And then we tend into a bit of a mixed kind of back end of July. Again, if it's going to happen, it should happen now from the statistics. Let's talk about demand destruction again. If you want to see demand destruction full in force, always look for copper. If copper is bouncing, that could be a good sign for things like oil as well, and also a good sign for other metals out there that maybe the worst is over. Do watch these types of charts. Obviously, this is what we call a Wyckoff setup. So here we have the Wyckoff setup. We have a false, what they call upward thrust, and that all precipitated into very big weakness. Now we're at the previous resistances becoming support. Maybe it's time for a little bit of a bounce here in copper, but at this stage, still a very negative looking chart. The US dollar becomes incredibly important at the moment. If money is flowing into the US dollar, what's it not doing? Well, it's not probably jumping into things like the stocks, the growth kind of assets. So we've seen a huge flight to safety, and the US dollar has become the predominant hedge. It's certainly not gold at the moment. We'll take a look at that soon. But we notice that things are flowing out of Europe. We've got outflows in Europe, outflows in obviously yen, outflows all over the world. They're all going towards the DXY. And unless this really goes down, there is a correlation, unfortunately, with the US dollar going up and the stock market going down. We've seen that correlation play out quite a lot. Now, it doesn't mean it instantly happens. A lot of you are saying, oh, well, it should happen straight away. It is preferred that if the stock market is going up, the US dollar is declining slightly or sideways. That is better at these times, these high VIX, high volatility times. But at this stage, I would like to see the US dollar weaken if the stock market's going up. Otherwise, if the US dollar keeps going up and the stock market's going up, it's usually not the best combo at this time in the stage of this cycle. So of course, what we're looking at then is the potential of a false bullish move, a bull trap, and we want to stay away from those as much as we can in the markets. Speaking of traps, oil really showed us over here that it was mean and it didn't mean business anymore. The destruction, the retap, and then of course this big short that's come through recently. It's got a lot of people, I'm sure, that are bullish. At this stage, you're back down to a pretty fair price. Obviously, we fell into a point here that was 95. That's a good level if you're feeling bullish on oil. If it breaks underneath this 93.50, wow, guess what? Oil might go even lower. And you might think, well, that means that the end of inflation is here. It's demand destruction. So it basically means that, yeah, maybe the end of inflation is partially here, or at least high, elevated, increasing inflation. It will start to standardize a bit more. But we will have incredible weakness in the economies, which means that eventually the Federal Reserve is going to have to come back. And this is the problem that people don't realize. I'll just quickly bring up this chart here, and we'll bring up September of 2023. Notice the rate is around 3%. Now, if I bring up December of 2022, the rate is 3.2%. If I bring up April of 2023, the expectation is 3.4%. So currently the expectation is like this. As I said, the curve looks like this on yields. Hike, 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 destroy the economy. Oh, crap, better fix that. That's what the market is expecting. The Fed doesn't necessarily say that. That's just what the market is expecting at this stage. And of course, follow along on the channel because we will be covering these topics. Gold here, let's take a look at gold. Absolutely getting floored. It fell through both demands, didn't even show any recovery in here. And that's why you wait. You have the patience and you react, you don't predict. You might think, oh, great level. Yeah, it could be a good level. Didn't bounce up it. Could gold go even lower? Absolutely. Could gold go to 1680? Hey, it's possible. I put a meme at the start of today's video talking about gold and how so many people have been wrong. I see gold as a trading asset and sometimes a hedge against things like stagflation. However, this market is moving so quickly that you could be in a deflationary boom like this or a recession really quickly. And gold doesn't necessarily do that well in either of those markets. It does very well during stagflation. Do you know we're in that market? That's the question. Let's move over to Tesla. Tesla here actually doing not much. Another long leg doji candle. I can't really report anything in particular for Tesla here today. We've got our big resistance, our big demand support zone, and we're in the middle of nowhere land. If the Nasdaq continues to run, expect Tesla to potentially pick up. But for Tesla traders out there, bit lackluster. Maybe a break of the high or the low of the previous session could have some nice kind of movements in it. Let's now talk about rotation going on in the market. So here's ARK K. It's the best kind of market, I guess, like overall balance I can use to represent hyper stocks. That is, stocks that were rated on price to sales ratios more than anything else. Notice the interesting curve here that we've seen since May of 2022. Basically, ARK K versus the SPY. ARK is now outperforming the SPY. And if you'd bought down the low and you'd gone against the SPY, you're actually up a factor of 24.5%. So this is very interesting because, of course, it's underperformed for a very long time here. And look at this. ARK K versus the SPY at this stage is at a price, crazily enough, at its launch. That's right. ARK versus the S&P 500 is basically where it all launched in terms of relative performance. So that is just how much these stocks got destroyed. They fell from a percentage up here in a ratio around 80%. Very big fall off. Again, rotation starting to come in for these high growth types of stocks. Is this the market telling us that it's willing to recover relatively soon? Well, I'm not sure if that's yet, but certainly they're bottoming to a degree here. XLK, another big one. This is, of course, technology versus the S&P 500. Now, it's still up pretty heavily. You'll notice here 2019, 2020, and of course the top. So XLK, technology versus S&P 500. Basing, got a really nice level around here that seems to be holding up. If that breaks down, watch out down below. Of course, that would mean technology is going weaker. But if it starts to rally and gets through some things here, like maybe a trend line such as this one, could that show us that we're in a very good period to potentially have more technology stocks than the S&P 500 itself? Because some stocks like the energy stocks, the metal stocks may not be performing as well. Absolutely, it could mean that. Why do we know? Because things like value are starting to drop. Value was doing incredibly well. Warren Buffett's fund did pretty well. Look at this, November 21 to really now. Who did better? Value investors or standard SPY investors? The answer? Value investors. Value investors kicked everyone else's ass. Have they done that in a long time? Well, no, not by the stats here. So this is an interesting one. We're seeing a bit of destroying here in the value side, and that could mean, again, it all kind of points towards that underground kind of rotation that's occurring in markets. A really important concept. Let's move over. That's more of an investment concept, by the way, than a trading concept, but it can help you to understand where the money flow is and therefore where the bigger runs are going to be. Buy the things that have the money flow in them. That's the better way of approaching markets. So what that's telling you is that at the moment, we could see outperformance of the Nasdaq versus the S&P 500 in terms of when things pick up. So here's the Nasdaq. It actually broke and closed above our downward trend line here. This could be a lead, I'm saying, for the S&P 500. Things are looking a little bit better here. We've broken out. There's no other way you can look at that. I mean, yes, it's a trend line. I don't really love trend lines too much, but it certainly has broken out. It broke past this resistance. It's bottomed to a degree, and it looks like it's improving. Hopefully it is, and we're correct on that. Let's move over here to the S&P 500. Did it break out? Well, certainly not the downtrend. It's nowhere near it yet, so it's lagging the Nasdaq from that aspect. But we can see that this little coil market here, it's actually gotten above. So it's kind of pointing towards the potential here for some strength coming into the non-farm payrolls numbers, the jobs numbers in the US. Let's hope that's what happens, because at the moment, the price action is mostly looking towards the bull side here on the really short timeframes. Now, is that consistent with what we're seeing underneath the hood? Well, we're seeing a rotation into growth stocks. Obviously, that seems to be what's happening, but we also don't necessarily have the big funds going heavy in the market yet. We're not seeing that kind of uptick in everyone feeling so good. So at this stage, even though we're having this rotation in, and I'll continue to update you to see whether we actually have the real flow coming through, at least from the way I look at it. At this stage, these bull rallies could seriously be bull traps. That is, markets come up, they squeeze all the positions, they squeeze all the shorts, they actually additionally add shorts, and then they dump it later on into the back half of 2022. Certainly quite open for that opportunity and option. We know that we have a big level of support here. Bears, you'll be looking at getting it through 37.40 if you can. Probably your little smiley face, you're like, yeah, that's right, I'm a bear. I got it right. Look at me. And at that point, anything's on it. I think you could go easily down to 36.75. And if you break a new low, well, of course, 3,500 is the next logical zone for the S&P 500. Many big bond players out there believe 3,200 or 3,500 are very, very, very likely this year. We'll find out whether it is. From the current price action at the time of this recording, you can kind of see here some nice consolidation. A lot of orders here. Broke out in the previous session, pulled back. Do we get that kind of slingshot trade? It seems like it's the kind of logical one. Bears will also be looking underneath here. You bust that, and if you don't return very quickly, of course, where you're going to move to, you would think you're gravitating towards 37.40, and I wouldn't like my chances the fourth time down there. Let's have a look at the S&P 500 options now. Now, I've gone out a week. This is until next week's expiration. You'll notice here that we have 394 as the max pain. Interesting. It's a little bit higher than when the current market is. So in the future, it's kind of saying that the market should make it up if they want to option expire at the perfect kind of levels. For this week, though, we're sitting at a 380. Now, I don't use max pain as a target. I just like to know where it is. And particularly, I bring these charts up so we can see where all the options sit. We have options sitting at 370, seems like a baseline kind of support level for the week, or 367, that kind of area here, seems like a very good support. And from a resistance take profit level, if we were able to get there, which seems unlikely, but anything's possible, that 410 kind of gives you a bit of a resistance parameter. That's how you use it. You kind of get that idea of everything in the middle is all very possible and all very likely. Let's move over to the Bitcoin market. Slight recovery here in Bitcoin, 20,400. Things are looking better in Bitcoin. We have this kind of like bullish kind of looking candle. We've got two long leg dojis, break, bastard, come back, instantly was picked up. It kind of looks similar to the other styles of returns. We get that kind of seller's climax both times. Then we get that double dip. Sometimes we even get a third dip on Bitcoin before it comes back up. So if you think about, here's the double dip over here. Here's kind of like the quad dip, and then it comes back one last time, scares everybody, and then slingshots up. I like to be very patient in a market like this. We don't know Bitcoin's bottom. We don't even know Bitcoin has to follow the stock market. It doesn't have to. It's a risky asset and therefore it will trade like one. But at this stage, it's kind of stuck between our supply and our demand, and we're looking for those signs. I would say it looks okay, but it's going to need the stock market to really pull up to even allow it to see some actual ramping here. If you haven't already, follow us over at FX Evolution on Twitter. We also have a Discord community with 10,000 people in it. So come and join us. There's plenty of discussion about indices and stocks and helpful information in there. It's awesome. Some great economic charts and memes as well if you enjoy those. And if you're ever interested, of course, we do have a private community as well where we do a bunch of pre-market streams and a whole bunch of other stuff in there. So you can join free 7-day trial in the links down below. We do have some calendar information weekly here, and as you'll notice for the Thursday session, it's not really that big. Basically, it's all about the next one, which is going to be the Friday. The Friday is the non-farm payrolls numbers, and once we see them come out, we'll have a very good idea about what the market's going to do. The problem is, how do we interpret it? I don't try to interpret the non-farms payrolls number. You'll notice when you watch a few non-farms, what it does is this, woohoo, and then it goes like that. The initial reaction often can be incredibly wrong on this number if you've seen a lot of them. And that's because it's complex. And also, what if it's bad? Well, if it's bad, the market could interpret it as the Federal Reserve will have to come out and support the market earlier next year. The market's looking in the future, guys. That's where it is. It's in the future. It's not back to the future. They're in the future. So because they're over there, what's going on? Well, basically they are already saying, well, I know Mr. Fed has to come back. Jerome's coming back at some point, and they're already going to say, okay, economic recovery in, which is just crazy, but that's how it works. It's totally trading in that future perspective. So we'll find out. This number should be interesting. I think jobs numbers will be the big pinnacle of what's going on here in the market over the next few months. Everyone will look at them, even though they're a lagging indicator. And if you enjoyed today's video, please remember to subscribe, smash that like button, and we'll see you in the next one. Bye for now.